Welcome to Lecture 1 for Portfolio Management on the topic of Introduction to the Investment Environment. The key theme of this lecture is to understand what is meant by an investment philosophy and identify the importance of having an investment philosophy. An investment philosophy is a coherent way of thinking about markets and how they work. Before you invest, investors should have a clear approach to investing within financial markets. This approach should contain your views of how markets work and most particularly your perspective of how efficient markets are. For example, if you are to believe that markets are perfectly efficient, then the only rational investment strategy is to diversify widely, minimize transaction costs and perhaps invest in an index fund. Whereas if you think markets are less than perfectly efficient and there might be some inefficiencies that you can exploit, then your investment philosophy should detail those areas that you believe that markets fail and identify how you could potentially exploit those opportunities. Most investment strategies that we hear or read about are implicitly based on some idea of market failings. Now, having an investment philosophy is very important because one way to think about an investment philosophy is that it creates the blueprint or the plans for your future investment. Now, a builder wouldn't go and build a house without plans, and equally, an investor shouldn't go and invest without also having their own investment philosophy. The key reasons why an investment philosophy is so important is because, first of all, without an investment philosophy, you'll be lacking a rudder or a core set of beliefs to guide your investment processes. When you lack this core set of beliefs, you'll be easy prey to be susceptible to behavioural biases that do affect individual participants within financial markets. Second of all, if you don't have a clear approach or a clear philosophy, then you'll find yourself switching from strategy to strategy, following the next new fad or potentially investing in strategies that have performed well in recent periods of time and changing out of them when they don't perform well. And all that does is incur significant transaction costs and often won't result in outperformance. Finally, having an investment philosophy is important because an investment philosophy is personalised. So one thing that's important to note is that there is not one ideal investment philosophy that should apply to all investors. Investment philosophies should be personal and they should relate to your personal characteristics. So having an investment philosophy enables you to design an approach to investing that relates to your own personal circumstances. So the second key learning area for this lecture is to identify what are those circumstances or what might be the individual characteristics that affect portfolio management. Well, an investor needs to consider their circumstances, and those circumstances first of all include the time horizon of investment. So if you're investing for a long period of time, there are going to be different philosophies and different strategies that are relevant as opposed to if you're investing for a short time horizon. Now, investment horizon is important that an investor can't just identify what their ideal investment horizon might be. So it's irrelevant to just say, I intend to invest for the long term. You also have to look at practicalities. For example, is it likely that you're going to be needing to withdraw money at some point in time in the future, in which case your investment horizon is going to be shortened? The second key characteristic that's important for investors to consider is their own personal tax status. So as an investor, we're interested in our after-tax returns on investment. And that's going to vary according to different personal income tax rates, different domicile taxed areas, so different governments will tax you at different particular rates, and also how you're investing. So for example, if you're investing through a superannuation fund, you're going to be taxed at a different rate versus a personal investment. So what that means is you actually might have a different investment philosophy for different parts of your investment portfolio because they're subject to different tax rates. But understanding tax situation and applying it is another important consideration. A third very important consideration for investors is their degree of risk aversion. So it's quite widely agreed that most, if not all, investors are risk averse. What that means is that we're only willing to take on additional risk if we're rewarded for doing so through higher expected returns. However, what differs across investors is the degree to which they are risk averse. Some investors are more risk averse than others, and your degree of risk aversion will affect the type of investment that is most ideal for you. So once you've created your investment philosophy, and that investment philosophy relates to both your views of how markets work and your personal characteristics, it's then important to understand how you can go about executing that philosophy. So execution is the time we put our plan into reality. And when executing, there's a number of factors that need to be considered. First of all, you need to understand the market microstructure issues that impact on the particular markets within which you're trading. So the first thing to understand are that there's two main types of markets in which securities are traded: order-driven markets and quote or dealer-driven markets. In an order-driven market, such as the Australian Securities Exchange, you can trade by placing orders at which you want to buy or sell some asset. So for example, I can place an order tomorrow that I would like to buy 10,000 BHP shares at a price of $14 each. Now, I can place an order to buy or sell at any price I like. I can nominate the price I'm willing to buy or sell for, but obviously that transaction won't be processed until such point in time as someone on the other side of that trade agrees to buy or sell for the same price. An order book will be formed then, which basically has all the requests to buy and sell and all the prices at which people want to buy and sell for, and trades will occur every time there's a match between those two sides. In a quote driven market, such as the Nasdaq, the market is dominated by market makers. So these are professional financial institutions who set prices for trading. So they'll set what the buy and sell price is for any particular stock, and investors buy or sell not with each other but via that market maker. Another important consideration when executing a trading strategy are brokers. So it's important to note that as an investor, you're not actually able to directly access equity markets. Only licensed brokers are able to do so. And therefore, we have to go through a broker in order to place a trade, unless you hold a brokerage license for yourself. So understanding the process of brokerage and also understanding the costs associated with different types of brokerage is an important part of trade execution. That leads us to the idea of trading costs, which is another important consideration. Trading costs should have an impact on our investment strategy. We need to consider them when formulating what the ideal strategy is, because some approaches to trading can be very expensive. So there's three different dimensions of trading costs. That is the brokerage cost, so the fee you pay the broker in order to execute your trade. The bid-ask spread, which is the difference between the price at which you can buy and sell a stock at any particular point in time. And the price impact. And the price impact is the idea that by the mere act of placing your trade, you'll actually have an impact on the supply and demand for that particular stock. Hence, you'll impact its price, and you'll actually have to buy or sell for a slightly different price than what you intended because of the impact you have on that security's price at the time of trading. Now, all of these factors need to be understood, the idea of how markets work and how you execute, and they should be formulated as an important consideration into your investment philosophy. So last of all, the various components of trading costs and the factors that affect bid-ask spread. So as I mentioned before, trading costs do comprise three dimensions. Those three dimensions are brokerage, bid-ask spread, and price impact. Now, if we look specifically at the bid-ask spread, that's probably the most widely identified aspect of transaction costs, and bid-ask spreads are different for different stocks across the market. Some stocks will have a very big bid-ask spread, which means the cost of trading that stock is very large, while others will have a very small bid-ask spread. So some factors that affect the bid-ask spread: first of all, the liquidity. Stocks that trade more frequently will actually have a smaller bid-ask spread. Stocks that trade very infrequently, they'll actually have a very large bid-ask spread. Second of all, riskiness. More risky stocks will tend to have a larger bid-ask spread. The size of the company and the price level. So smaller firms will tend to have a large bid-ask spread, and firms with a low share price will have a large bid-ask spread, while big firms and those with a high share price will have a smaller bid-ask spread. And also, because the bid-ask spread can be reflective of the risk of trading the firm, because it measures your ability to quickly buy and sell, company-specific factors such as the corporate governance and transparency of information release can also affect that spread. So firms with less adequate corporate governance will also tend to have bigger spreads. So that's a summary of the first lecture. As I said, important to note, investors need an investment philosophy. It's part of thinking about the funds management process as a science rather than an art. That investment philosophy is an important way of guiding an investor, but it should also consider your personal individual characteristics. When it comes time to executing that strategy, you need to think of taxes and you need to think of transaction costs, as well as a multitude of other factors. And last of all, we've identified that trading costs are multidimensional, they're multifaceted, they incorporate brokerage, bid-ask spread, and price impact, and different firms will actually have different costs of trade for their securities. And generally, smaller, riskier companies will be more expensive to trade than bigger, less risky companies. Thank you very much for listening to Lecture 1's presentation.